Canada, the economy is going to be stronger than ever. The government is doing whatever they can do on their end to trigger home ownership, to trigger the market. The inflation is down. It's really low right now. We are seeing the lending rate at 2.5%, which is not bad. The prime rate went down as well as 4.7%. So clients should not look into own ownership and say they cannot buy. We are in a strong position right now. Lenders are doing their part as well too, where they are.
Hello, beautiful viewers. Welcome once again to the Nana Yaa Yeboaa Podcast, wherever you're watching. I hope this conversation brings you joy, brings you some transformation, etc. Listen, I'm very much appreciative of those who've been watching this podcast. 96% of you watch the podcast on occasion. You keep coming, but you do not subscribe. I will highly encourage you to subscribe so that I can bring transformative individuals with knowledge, just like Jermaine here today, so that you can, learn a thing or two about how to transform, how to change where you are, and how to build legacy and generational wealth. So today on the Nana Yaa Yeboaa podcast, I am joined by Jermaine Whyte of Pineapple Financial, a trusted advisor helping Canadians turn the dream of home ownership into reality. From mortgages and refinancing to creative rent to own solutions, Jermaine is passionate about making financial stability accessible for everybody. We are going to dive into his story, his expertise, and his practical advice for anyone looking to buy a home or build wealth through real estate. Jermaine, thank you and welcome to the Nana Yaa Yeboaa podcast.
It is a pleasure to be here. Thank
Yes,
you. Thank
yes.
you for having me.
Thank you. This conversation has been long in coming since 2021.
Yes, it
And
has been some time.
yes, and we've hit, the hit and miss and forgotten and etc. But as Jermaine said before we came on, this is the right time for us to be having this conversation. But before we get into it, who is Jermaine Whyte? Where did you come from? How did you get into this mortgage business? And why should I trust you?
Okay. Um, so I'm originally from Jamaica. My background is in finances. I studied business administration in Jamaica. Growing up in Jamaica, your parents always want you to do similar to what I'm guessing in Africa as well. Either you gotta be a doctor or a lawyer or an accountant. Three things, right? So I did the latter. I studied finance in Jamaica. I came here in 2001. Went to York University and graduated with a degree in economics and philosophy. So after York, I dived into the music business because my family has a construction and a music background. So my family is contracted with Guinness. Guinness is a liquor company, and we are contracted to play at Guinness sponsored events worldwide. So I would find myself 7 months out of a year in California, another 7 months in England. So I was rarely in Canada at the time. And mortgages was far from my mind outside of my grandaunt, helping my grandaunt with her rental properties, um, my family as well to purchasing their own properties. Outside of that, mortgages was far from my mind. In 2019, late 2019, I decided to come back to Canada from California to see my children, and COVID hit. I got stuck. So when I got stuck, it was God's calling, as I spoke to Nana about. Nothing happens. Everything happens on God's time. So when I came back, COVID happened. All the contracts now were void because nobody could travel. So there's no music events anywhere. So someone said to me, "Do mortgages. Why don't you do mortgages?" And I said, that's a pretty good idea. First they said real estate. Get into real estate because you're a people person, and it's a easy transition from the music business to real estate. Because I was in the people industry prior. Then I said, but real estate, I don't think I can do all that driving back and forth all over Ontario just to show a house. I don't think I'll be able to do it. What's the next best thing? They said mortgages. And that's when my career started. It's a beautiful career. I started December 2019, and it has been ups and downs, mostly up, but it has been amazing since then.
Wow, that is from music. We already know your background is finance, economics, but from music on the stage with the mic and all the how do we call it, sounds going on behind you, to mortgages.
Well, I wasn't on the stage. I was behind the scenes. I was the agent for the
Okay.
company. So I handled the payments aspect of the business. So I wasn't on the stage, but I was in the background enjoying the music and the
Okay.
festivities, etc.
So you were still dealing with the money behind the.
Behind the
Okay.
scenes, yes.
Okay, now it's thank you for that clarification, because my mind was almost blown out of my head with that. Nice, 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 nice. So we are now in doing mortgages for these few years,
Mhm.
and what has your experience been like in the industry?
Um, it has been good. It has been bittersweet. Good because I'm able to help a lot of people. Bad because I I take a little bit of everybody's sorrows with me, and I've seen a lot of things happen to good people. In 2023, I did 12 power of sale deals, which was not good. I've seen people that became alcoholics because of homes. I've seen people that contracted diabetes because of stress. I've seen people die because of the stress of home ownership as well too. And all of this came from not getting the correct information and the correct guidance to lead them in the right direction where they can own a home and maintain that property over time. So so it was good because I'm able to help a lot of people. It's a joy to help people, but it's bad when I have all of these bad stories or sad stories to tell.
You know what? It's I would love to hear one or two of those challenging narratives or stories. The reason being that if somebody is going through something similar right now, then they know what to do.
Okay.
So if you don't mind, then you can share a story of two without mentioning names, what some of those challenges were, and going to power of sale and what could have been averted.
Okay, so the main issue with a lot of people is they have this misconception that their home is a bank account. So they
Mm,
should use their house as a bank account. And once they have enough equity in their home, they should exhaust all of that equity, especially when it comes to private mortgages. And they don't understand that not every private loan is a good loan. And over time, when you exhaust all of these equities in your property, right, now it becomes an affordable issue because now you cannot afford this mortgage. And over time, the lender will come and take your home. And the stress from this, I have one client, 1 year, she called me 10:30 in the night. The sheriff came and locked her door at 10:30 in the night. She had to put her out, put her children out, everybody out. And it all came from overuse of the equity. And that's what leads to a lot of power of sale because a lot of these clients are misguided by
so,
other people.
so when you say overuse of equity, that what does that mean?
Okay, that's a good question. Overuse of equity means when you do a refinance to pull for a second mortgage for a second mortgage per se, you go to speak to another mortgage agent and they don't give you the right direction. Maybe they have 50% equity in their home to use,
Mhm,
and right off the bat the mortgage agent don't give them the right guidance to say, listen, the more equity you use, that will increase your mortgage payment because it is going to increase your borrowing amount, the amount that you're going to borrow
mhm,
from the
mhm,
home. Right, so if your
mhm,
original mortgage were for say example $200,000 was your original mortgage, and you go and you take out an extra $100,000, now your mortgage increased to
300.
$300,000, which increases your payment. And you also have a second mortgage as well too on that property that over time builds interest if you cannot pay it out. Then the renewal comes in, and every renewal that there's an increase in the amount of that second mortgage. And at times it puts strain on people because when they qualify for the home, they qualify for a specific amount of mortgage payments. Now that payment increases over time, which may force people at times to, you know, use other sources, maybe credit card, line of credit, borrow money from say a Easy Financial or other financial institutions,
Mm-hmm.
and it puts extra strain on their resources, on their financial resources, and these extra strain is what lead them to lose their home because now they have to say take from Peter to pay Paul type
Mm-hmm.
situation. You know, take from one bill that you were supposed to pay another bill, and that at times put a strain. And some people just give up, some because they just can't pay it, and that's when the lender comes in and take the home.
Mm-hmm.
So
Okay. So, in your experience, what have you seen people really do with all these monies that they take out? Is it for health reasons or for buying vehicles or home
uh,
improvement?
people take money out for different reasons.
Mm-hmm.
Um, and it comes down to the options. A lot of times people don't know what their options are and they panic.
Mm-hmm.
So maybe someone may have, you know, they may decide that, you know what, I want to buy another property. And the mortgage agent may say, okay, then, you know what, I am going to assist them to purchase the property, but not speak to them about the financial strains of purchasing that property based on what their income is. And then
Mm.
they turn around and they pull that income, pull that equity out of their home to purchase another property. And now there becomes an affordability issue because what they're earning cannot carry two mortgages,
Mm.
right? So it
Mm.
comes down
Mm.
to misguidance. You know, they're not properly guided in that regard. Sometimes people take the equity out to, you know, be flashy, buy a car, and sometimes it's for medical reasons. You know, people, you know, unfortunately, situations happen where they have to pull funds out for medical situations. But for me, before I lead them down that road to pull the equity out, I try to find different solutions for them first.
Wow. Financial strain and health goes hand in hand to,
Yes.
together. And really, I really want listeners or viewers, whether you listen to us on Spotify or you watch us on YouTube, to really understand, that mortgages isn't just mortgage, but there is underlying issues that go with it. But let's put that aside for 1 second, and let's get into mortgage, owning or buying property. My
Mhm.
first question is it for everybody?
I believe so. I believe everybody deserves to own a home if they so desire to. The possibilities are there, and I've worked with clients over time to build up their financial resources to purchase a home. So it is for everybody. It just the issue is it's not gonna happen overnight for everybody because not everybody has the same. It's not isn't the same socioeconomic background. But I believe home ownership is for everybody once they choose to pursue it.
Okay. So let's take, for instance, I'm a client. I don't have any property
Hmm.
yet, and I earn between say 60,000 to 80,000 or 90,000 a year, and I am interested in owning a home, and I come to you. If you're able to go through, the process you take me through to get to that level.
Yes. Yeah. Okay. So what I do if when people come to me in that regard, say, okay, they want to own a home, there are a few questions I ask them. My first question, what is your credit score? Because that is very important.
802.
Well, you have a very good score, right? Because any score above 680 is really good because that assists you with premium A lending products.
Mm,
Okay. Now, I look into the credit score, I look into the income. Generally, all banks look at it minus the liabilities is 5 times your yearly income is what you generally qualify for. So the client comes to me and say they make $90,000. Okay, off the bat, that's $450,000. Within that realm is what they will qualify that for. Okay,
Okay.
now what a client says they earn and what the mortgage agent or the banks qualify them on based on income is two different things, because a client may feel as if okay they just earn $90,000 from their yearly income, but maybe this client has children. We can use CCB income as well too.
Mm-hmm.
Maybe this client has pension or owner's income. We can use that income as well. So whatever consistent payment that they're getting, we can always use as income as well, and that will help to tack on to what they already claim as income. So
Mm-hmm.
so right off the bat, say the client um, gets $20,000 in child tax benefits per year. Now that's $110,000. They came to me with 90,000. Now they earn, now they have 110 to qualify with
Mm-hmm.
based on the child tax benefit, and that will increase their qualification range from 450 to say 550.
Mm-hmm.
So now they have more options to choose from. My other question I would ask my clients is, what are your plans for the future?
Mm.
Right? Where do you see yourself in 5 years? And that will determine the type of property that they may look to purchase. If it's a family that just got married, what are your plans in the next 5 years? Generally married couples in the next 5 years, they want to have children. Now we got to look into purchasing a property, a bigger size, a bigger space property to constitute a family. Okay, if this client say, okay, the next 5 years I plan to travel, then maybe we scale down on the property size and the property value to qualify them. And it also help as well to as it relates to what lender to put them in, right? Because if a client is looking to purchase a property to rent, then I look at a Scotia program, because Scotia has the best rental programs. If a
Like Scotia Bank.
Yes, Scotiabank. Yes.
Okay.
If the client say, okay, I'm interested in interest rates alone, nothing else, then I look at other lenders with a lower interest rate or lower features that suit that client based on their future goals for the next 5 years. So it's
Mm-hmm.
not just about the down payment and the credit score. I like to know what their goals are for the next 5 years, and that will tell me what lender best suit this client.
I was never asked all those questions.
Now, I ask a lot of questions. I don't just put clients in a mortgage. I like to know what their plans are. How can they afford this mortgage
Mm-hmm.
over time, and etc.
Wow. So what if say there's somebody who doesn't really think that home ownership is, it's like they're okay, but they think home ownership in this day is not for me, or it's like the market is too saturated, it's over the bar, I can't afford. But within that 80, say 60 to 90,000 range, what is the best, conversation to have with such a person?
Well, a lot of people think they can afford based on the misconception out there. Some clients think they can afford based on the down payment rule. They think they need to put more down payment down, say 20%. A lot of people aren't aware that they can do 5% down to afford. Some people believe they can't afford because they may go to the bank, a TD or a Scotia Bank, and they tell them, okay, you don't qualify for a mortgage, maybe because of the credit score issue, or you're carrying way too many debts, but their down payment suits an alien up for 5%. They don't
Mm-hmm.
know, they don't understand that there are other programs out there that can assist them in owning a property. There are down payment assistance programs out there that can assist these clients as well to own properties. So I find many people that say home ownership is not for them. They say that based on what the banks might tell them, or what disadvantage
Mm.
they have, maybe because they have the student loan and the car payment,
Yeah.
maybe because their credit score is 600 or 550, so they think, you know what, I can't qualify, or I can't afford.
Mm-hmm.
But
Mm-hmm.
there are programs that assist people with credit issues as well too, for them to own homes as well. So there are different programs out there and lending features out there to help people. So if someone comes to me and say, you know what, home ownership is not for me, my question to them is, why do you think home ownership is not for you?
Mm-hmm.
Because there's always a reason behind why the person may say that,
Mm-hmm.
right? And most times it's because there's lack of knowledge on their part, and sometimes they just feel deflated because they go to one bank. Because many people depend on the traditional lender, the TD, the Scotia, and the CIBC, not knowing that there are different lenders out there that's not available to the public, that as down payment assistance programs or have different features and programs out there to help people to own home.
Now that brings me to the rent to own
Mhm.
that you also curtail. So, what is rent to own?
Rent to own is another program there that assists people to own homes. This program is it is a really good program, and it's a bad program. It depends on the company that does the rent to own. So
Mm,
first thing, if a client is looking to do rent to own, I always advise the client, make sure the company is a reputable company. Excuse me, research that company that you're looking to do rent to own with, right?
mm,
Now, with the rent to own program, it's an easy access into a property because it allows the client to place minimum 5% down on the property that they like. And when they make their payments every month, 20% of that payment goes into a trust account towards the end of the term of the rent to own. The term is generally between 2 to 4 years, okay?
mm,
And the home is 110% yours. So you have to make sure you maintain the property. The thing about the rent to own is every month there's three payments. So the payment that you make every month is split into three. 20% of that payment goes into a trust account, as I mentioned, that goes towards the down payment at the end of the term. Another portion goes towards the property taxes for the property, and another
okay.
portion goes towards the lender or the investor. So it is a little bit more expensive to go
Mm-hmm.
into this program. And for this program, it's generally the last resort for me
Mm-hmm.
because a lot of clients come to me for rent to own, but I find that they qualify for other programs.
Mm-hmm.
Okay. Now, at the end of the term, once the client fixes whatever issues they had to go into the rent to own program, then I would do a
Mm-hmm.
refinance to put them into a different mortgage. Okay.
Mm-hmm.
Now, with this rent to own program, it's generally for people that say, owe $100,000 in taxes, have really bad credit, and want to purchase a property. That's generally the people that I would advise to go into this program. People come to me with the misconception that they cannot own a property. So they say, Jermaine, put me in a rent to own program. And I say to them, but Nana, your credit score is 800. You already have 5% down. Why would I put in rent to own? What you're
Mm-hmm.
doing is paying me more money, Nana. Let me put you
Mm-hmm.
with a TD. So that's
Mm-hmm.
where my questions will come, right? So I don't just put a client in a program because they tell me to place them into that program. I like to ask questions. What is
Mm-hmm.
your credit score? What are your plans? What does your income look like? What does your affordability look like? Let's look at your debts. And
Mm-hmm.
then I would decide to put them in a rent to own or a different program. But it is
Mm-hmm.
a good program. It's a stopgap program for people that wants to own. Just know that the term is between 2 to 4 years. The payments is a little bit higher based on what you're getting for it. But it's generally for people with high debts
Mm-hmm.
and low credit scores. Credit
Mm-hmm.
scores below 600, debts say 100,000, 50,000, 60,000, and they only have the 5% down. Those are the clients that generally would fit into that program.
Okay. Okay. Well, I never knew that.
Yeah.
And I thought I liked digging a little bit, doing more research, but I had no idea. Wow, thank you.
You're
Now,
welcome.
you mentioned debt, and it's like, whew, many of us are under debt.
Yes.
And many of us are under debt. So beyond first homes, as how do we call it? Say, how can debt consolidation through mortgage solutions help reduce financial stress? You did mention about people going through a whole lot of stress and you have
Mhm.
a power of sales. But if we're not going through power of sales and everything, where do you come in? How do you support some of us who are in debt get through this cycle through mortgage refinance?
Yeah, and that's a pretty good question. Lenders appreciate the fact that since 2022, 2023, when there was that high inflation, a lot of people accumulated debts, especially those homeowners that had variable rate mortgages that had to pay high amount. Now they had to go to credit cards, they had to go to different means to borrow money, easy financial, Fairstone, etc. Now what debt consolidation does, it's a really good program because one, it reduces the interest rates on what you're paying. All right, it consolidates every payment in one, all your payments in one, which frees up cash flow. Now, how I come in with as it relates to debt consolidations, I may offer clients credit cards or line of credits. Some clients prefer, say, um, consumer proposals, but for me, I don't like that because there may be other options, especially for homeowners. So I provide line of credits or credit cards for these clients. There are equity-based credit cards now available up to $3 million. There are line of credits available for clients, not just with A lenders, but B lenders and even private lenders have access to line of credits as well too. So I prefer a client to have something more revolving where
Mhm.
they can pay and use because these clients that are coming out of debt at times they still need that extra fund to do something or they're going to find themselves back into debt. So I put them in a more revolving type product that can assist them over time.
Okay, that is excellent. That's good. Now you did talk about line of credit, but for that, and I want you to talk a little bit about HELOC, home equity line of credit, right?
Mhm.
Because some of us hear the term, we don't really know what it is or understand it. So that if there are any homeowners listening and going through any financial constraints, they could see that there's something also called a HELOC and the line of credit that you explained, and how to navigate it.
Yeah, okay. So as it relates to home equity line of credit is what it means, is what it says.
Yeah.
It's basically you accessing equity in your home to a line of credit. Now, with A lenders, they do it up to the loan to value up to 65%. Some go up to 75% of the value of the property, and your line of credit cannot exceed what your mortgage is. So
Hmm.
now this is a revolving loan, and it's offered with A lenders and a few B lenders will offer it. Private lenders do offer it as well too. But the good thing is with the private lenders and the B lenders, they offer it up to 80%. Now,
Mm.
A lenders offer it up to 65%. Client private and B lenders offers it up to 80%. And what this line of credit is, it is revolving and it allows you to access this equity in your home to use over time. Now, there are other equity-based loans as well too, because line of credit is an equity-based loan. There are credit cards as well too that's offered to two lenders. And these credit cards are similar to home equity line of credit, but it is different in a way where these credit cards goes up to $3 million. It's equity based, so the qualification is a lot different. With the home equity line of credit with an A lender, they qualify you based on your debts, your ratios, as well as your credit score. Right now,
So, sorry, when we're talking about A lenders, you're talking about the banks.
yes, A lenders. When I speak about A lenders in the banking world, we have three types of lenders. We have A lenders, which is the TD, the traditional lenders, the TD, the Scotia, the Manulife One, RBCs. Then we have the B lenders, which are alternative lenders to the A lenders, and these B lenders are alternate lenders that assist people that want to generally qualify with an A lender. And
So,
these
what will be an example of a B lender,
An
for
example of a
instance?
B lender now, these alternative lenders would be, say, a First National, um, a Home Trust, Community Trust, Equitable Bank. These are alternative lenders that assist clients that wouldn't necessarily qualify with an A lender. but they offer also good products as well too.
Mm-hmm.
But they're just not available to the public. You have to be they're
Mm,
accessible to a mortgage agent. And
mm,
private lenders, or what we call C lenders, are as what it's called, private lenders, and these are generally through private investors that pool their funds together to what we call a MIC, or mortgage investment corporation, right?
mm,
And these people, their loans are equity based, or sorry, interest based,
mm-hmm,
interest
mm-hmm,
only, right? So they also offer products out there to assist clients as it relates to line of credits, etc. Right? So there are options to consolidate debts if the client want to say qualify with a TD or a Scotia Bank, because going to a TD or a Scotia Bank at times these clients don't qualify because they go outside what we term as a ratio. They don't
mm-hmm,
qualify. So now they have to go within the realms of say a B lender or say a private lender. B lenders and private lenders with their line of credits and credit cards is offered to what's called an equity base. Now
mm-hmm.
this loan qualifies not so much, it qualifies you on the credit score as well too as you go on the B side, but not so much on the income. It's mostly on the equity of your home. Obviously, you have to show affordability as well, but not so much as you would have to show if you was going with an A lender.
I am smiling because I recently had to sit and do a deep dive of everything. Now, I don't like paying too many bills. And
Hmm.
so I had a few bills going left, right, and center. And I said, no, it's like being pulled all over the place. I need to consolidate. So I went through and my score is good. But I happened to go through a B lender because relatively their interest rate was lower.
Hmm.
Now, what I didn't realize was that really you using this money, even though it's tied to your home, you're still paying.
Yes.
I don't know what I was thinking. I got a first bill and I almost got a heart attack.
Yes. Yes, because the line of credit bill is really high. It goes based on some lenders. Every lender calculates their line of credit differently. It's based on the prime rate,
Mhm,
right? And the prime lending rate is basically what the general banks use as a conventional rate for a variable rate mortgage. So the prime rate currently is 4.70. So some lenders, they tack the interest rate based on the prime rate plus an added amount, and some the prime rate plus a minus a certain amount. So for example, if you were going with a B lender, some B lenders will do it prime rate, which is 4.70 plus 4.
mhm.
So that's where now you find that high interest rate, because now it jumps to 8.70, what the line of credit you're paying, which is a lot more than what your mortgage interest rate would be. So that's where you
Yes.
almost fell, because before you got that line of credit, the mortgage agent didn't um, warn you that, listen, this is going to be your payment every month based on the interest rate. And that's what I do. If a client comes to me and say, Jermaine, I want a line of credit, or I want a mortgage, I want to refinance, I run the numbers by them and I show them what their payment will be if we go this route, what the interest rate will be and what the payment will be. And then the client will decide, listen, you know what, maybe let's wait a little bit until next year we do a renewal, pay everything out, or I can't wait, let me do it now. Because sometimes clients think they need to consolidate this right away, but sometimes they don't need to. Sometimes your renewal is coming up in a year's time. They can we don't do that in a year's time. Or maybe sometimes the debts aren't that bad. People freak out when they see a $50,000 debt. It's not that bad. I've seen that 300,000, 400,000, $200,000. I've seen debts that high. So people see that 20,000. Oh my God, I owe $20,000, Jermaine. Let me refinance my home. And I said, no, listen, you don't need to refinance your home. Let's do a financial needs analysis. Let's look at your finances. Let's look where we can move some funds around to assist you to pay off these debts. Because sometimes the client owes $50,000. But when I look at their bank account, they go to Red Lobster every week and spend $500, or maybe they go to the party and they spend $1,000, or maybe they buy a car and their car payment is $800 per month. Now, if we can bring that car back and they trade it in for another maybe a smaller car, but lower payments, or they don't go to Red Lobster every week, and if they go to Red Lobster, maybe spend $300 instead of $200. Now, when we calculate this could bring a particular debt down. So
Mm-hmm.
we may not need to refinance to put you in more debt, right? To pay off a debt when you can use the funds that you have at your own resources to pay the debt down.
Yes, I think for some of us it's a psychological thing that we needed to do. I
Yes,
just wanted one bill,
yeah,
so put everything together and pay one bill. So I just put all the money back, my just what I needed, and I just put all the money back. So the next payment was considerably
lower.
lower. Yes.
Yes, yes, because to consolidate it's not a bad thing, because and maybe I misspoke there, because when clients come to me to consolidate, I like to look at everything first to see, because if I see where they can manage without getting that new
Mm-hmm.
refinance, because sometimes when they get that new refinance, right, it eats up more equity in their home, and then when it's time for them to move to a different lending product, a different lending feature, or a lower mortgage payment, or a better lender, they cannot do that because they have that extra equity that's used up, right? So sometimes it is better where, if we can find the funds from our own resources, we take
Mm-hmm.
that route. But sometimes clients cannot find the funds from their own resources and the debts are so high where it's better to consolidate. And this is where now the consolidation, even though the interest rates are higher, but what happens, you free up cash flow, because
Mm-hmm.
if you had five debts, all that five debts goes into one. Now you
Yeah.
you you can concentrate on that one payment per month, and
Mm-hmm.
that eases the stress
Mm-hmm.
of paying all that extra amount every month. And
Mm-hmm.
that extra funds that you have in your pocket, you can either add it to that payment every month as what you did, or you could
Mm-hmm.
put it towards savings.
Mm-hmm.
A lot of people that consolidate debts, they find that they save a lot more over time,
Mm-hmm.
because
Mm-hmm.
now they're concentrating on one debt instead of five or six.
Yeah, yeah, yeah. For me, it was purely psychological that instead of paying a car this, pay that, pull it all together under one, and say free up some cash if I need, say, to do an investment and it really really need it right now. I can pull out 20,000 or 40,000 and know that I have to pay it back, but I can do what I need to do and have a plan to pay it back. So it was just that mental flexibility as well. But
Hmm.
if I don't need it, just keep it with them and
Yeah.
use only minimally what I need. Not just because I have that, so I could go buy this, go buy that. No, just use exactly what I need,
Yes,
and then
exactly.
that's it. Yeah.
I've done something similar to that. A file with a client. She's buying a property outside overseas, and she has a lot of debts as well too. And what I did for her, I gave her a $150,000 line of credit
Mm-hmm.
to consolidate the debt and buy whatever she needs to, and buy the property overseas. And I said to her, okay, the remainder of the funds, you put it one side towards savings
Mm-hmm.
and concentrate on the one payment. So all her past debts are paid off. She's able to buy that property overseas, which is now generational wealth. She can
Mm-hmm.
use it to earn income through rental or Airbnb, and that will help to pay the line of credit here. So consolidation is not bad once we have a plan in action of what we're going to
Mm-hmm.
do with this debt consolidation.
Excellent. Great. Wow. So let me ask you, for those that have say gone into the have their own properties, right? The difference in strategy when it comes to say mortgages between buying your first home versus purchasing an investment property. where you come in as a mortgage broker.
What again? What's the difference?
Yeah, the difference in strategy that you will present to somebody who who is buying their first home versus somebody who is going into buying an investment property.
Well, both strategies are similar,
Mm-hmm.
but with the investment property, I like to look at where the location is more so than someone that looking to purchase a property, because we have to make sure that that investment property is going to yield a return on the investment. So one strategy is to look at where that property is. Another strategy is the income, or the proposed income that that person will be making of that property. We can always use that as income towards purchasing that property. So
Okay.
I look at it as as an income perspective, which would increase their qualification or their options. So say they went in to purchase a property for $500,000, but the income in that area would yield a little bit more, where I could add that proposed income to their yearly income, where they may be able to purchase something even for more than the $500,000 in that particular area. I would propose that to the client as well too, because that helps them to purchase something a lot bigger or
Mm-hmm.
better, where they can yield more income, and the
Mm-hmm.
more income will assist them with their profit margin. And the location is always a big thing as well too, because we have to make sure that the location will yield that return, because a lot of people will buy investment property anywhere in Canada, but they lose because that area, the property values decrease more in that area than anywhere else. So one,
Mm-hmm.
they may owe more on the mortgage than what the property is worth, and the renters or the rental potential in that area is really low. So it
Mm-hmm.
makes no sense. So
Mm-hmm.
location is always good when we are looking to purchase an investment property, as well as what the return or the income yield
Mm-hmm.
is from that property. As it relates to someone looking to purchase a home, it is generally the same thing. When someone is looking to purchase, I always say to the client, wherever you're looking to purchase, do a research on the area, survey the area, see what the resale value in those areas are. And that will give you a general idea of what that property worth will be over time,
Mm-hmm.
because we always have to expect that anything may happen over time that might affect the housing market. And we want to make sure that your property is always growing, it's always yielding in equity. And once your property yields in equity, it increases your saving, and as well as it increases your net worth as well too. So
Mm-hmm.
we have to do our research to make sure that the area they are purchasing will yield that return based on what the resale value in that area is.
Excellent. Guys, if you are watching or you are listening, this is a master class. This is pure information, knowledge gathering, given. So please do subscribe to the channel and follow Jermaine Whyte wherever he is. I found him on LinkedIn. Now he's my go to person when it comes to mortgages, breaking it down to the nitty gritty. And not, I'm not kidding you. I'm not kidding you. If you find somebody needs this information, please also do share it with them because it's much, much needed.
It is.
Lack of Yes, lack of knowledge, lack of education, many people so do perish. And it is there. And it is there. And if you have any misconceptions about home ownership, but you want to live in a house and you are renting a house, just take it that you put 5% down, and the government, the bank says you can have this home to live in and pay the rent to the bank. And at the end of the day, when you are ready to move, you are told, oh, all the payments you made, we actually left some room for you and you can take this with you. So you are not just paying, you're not just putting your money out there, but you get a little something back. That was what one older man explained to me, that was how he thought about mortgages.
Yes, and one other thing with the 5% down that a lot of people don't understand or them don't know is when you're looking for homes, look for homes with eco-friendly products, or if you're going to do
Mm.
eco-friendly, say add something eco-friendly in the home, maybe with the window, make it eco-friendly, the door, or whatever in the home that is has the potential to be eco-friendly. And guess what happens? CMAC, Canada Guarantee, and Generate, which is the three major insurance companies, will give you a rebate on that. So there you're saving money as well too, when it comes to your insurance premium if you do 5% down. So when someone says, you know what, I can't qualify, it's not for me, I believe home ownership is for everybody. There are options out there for everybody. Everyone has the potential to own a property. It it just comes down to finding the right person that will give you the right guidance.
Excellent, excellent, excellent. So, looking ahead, what do you see as the future of home ownership in Canada, and how is Pineapple Financial helping shape that future?
Uh, um, Home ownership is it looks good. I
Mm.
believe we are going into 2026 where Canada, the economy is going to be stronger than ever. The government is doing whatever they can do on their end to trigger home ownership, to trigger the market. The inflation is down. It's really low right now. We are seeing the lending rate at 2.5%, which is not bad. The prime rate went down as well as 4.7%. So clients should not look into own ownership and say they cannot buy. We are in a strong position right now. Lenders are doing their part as well too, where they are coming out, or they're bringing forward different lending features that can assist clients to qualify easier to own property. And what Pineapple is doing, which I appreciate as well too, is Pineapple, through their agents, myself as well, we work with different lenders, on the with the A lenders, the B lenders, as well as private lenders, to help people to access home ownership really easy.
Great, great, great. Jermaine, thank you so much for sharing this information, your journey, and your wisdom with us today.
You're welcome.
Well, from your personal story to all the practical steps that you've laid out, it's clear that home ownership isn't just about buying property, it's about building stability, building growth, and creating opportunities and investing in the future. So for any of our listeners who dream of owning a home or strengthening their financial position, I do hope that Jermaine and the team at Pineapple Financial. I don't know how you came up with the name Pineapple Financial, but I'm here to guide you
Well, Pineapple is not
from
my
it.
company. I work with them, but the owners are really amazing people. And everybody asks me, how did they come up with that name?
Yes.
Yeah, I don't know.
How did they come up with the name Pineapple?
Yeah. It's a catchy name.
Well, I was looking for the pineapple. I haven't seen the pineapple yet.
You know what? I will invite you out at another one of our events, and I will show you the pineapple.
I will most definitely try and make it. Or, no, not try. I would definitely create time to make it when I get my invitation.
There you
Jermaine,
go.
thank you so much. Thank you so much for clarifying and giving us this breadth of information and depth. I appreciate you so much. Any last thoughts? If viewers or listeners are looking for you, Jermaine, where can we find you?
You can find me on LinkedIn at Jermaine White. You can find me on Instagram at Jermaine White One, and at Facebook as well, Jermaine White, JermaineWhyte. Or quickest way to reach me, you can give me a call at 905-598-2669. Again, that's 905-598-2669. And I have one other thing to leave with you, with everyone. We all say we can't own a home. What happened in 2020? A height of COVID. A lot of people bought homes at that time. And what we didn't realize is people bought homes because the government bought up all of these bonds. in the economy, which triggered home buying because everybody now had more money in their pocket where they can afford to purchase a property. So the government stepped in 2020 to help people to purchase a home. And now in 2025, we're seeing where the government is stepping in as well to where they are reducing the interest rates, the Bank of Canada rates, which is lowering the variable rate, which will assist people to qualify to purchase a home based on the lower interest rates. So the government is doing their part. I am doing my part. The bank is doing their part. So do your part, come out, give me a call or the right mortgage agent a call. And if the bank says no, Jermaine says yes.
Jermaine says yes, guys,
Like
and
for
that
real.
is a wrap.